Good morning, ladies and gentlemen. Well, the risk dial per se on the daily basis is working again. We're at 65, which is in the green, but the news is that the daily model has gone to risk off. That does not mean that you need to buy TLT, as you will see from what I'm going to say in the bond section. I think TLT is the cause of the slight risk off. So what it's saying, the model, is that you should be lowering your allocation to equities, but not necessarily going into TLT, as I will explain. What this is saying is that you should do some sectoral changes, and also that you should up your level of cash, because there will be opportunities ahead. Most probably we are entering a period such as this, where the market might go up, but it's going to be very, very slow. The upside is very, very limited, and there will be days when the downside gets tested. Now, the mere fact that these moving averages have crossed over doesn't mean very much. It's just a loss of momentum for the time being. The big one would be if the weeklies gave a signal. We haven't tidied it up yet. They have not given a signal as yet, but I will keep you updated. I'm really hopeful that by next week we have everything tidied up and the model works properly. And then we can do some big changes to the site and additions. But I will now go through the bonds first as usual and tell you why I think that we are in for a period of turbulence in both bonds and equities. The yield curve keeps on steepening. I mean, this was a very, very good signal that we broke out of this area of consolidation that we were in for many, many weeks. And yes, likelihood is that we trade up here towards 137, 138. The fact that the yield curve is steepening tells me that there is beginning to be fear of inflation in the bonds, and but the structure of it, as we will see in 5s 30s and 10s 30s, is not yet extreme. Although I would expect the 5s and 10s to be the worst performing tenures, as I will explain soon. The movement in the 5s 30s, and this is a weekly chart of the 530s, is nowhere near as extreme as it is in the 2s 10s. Now, we got on a daily basis to 95 basis points, got out. I think that we have to trade 124. That means that the yield curve will continue to steepen. And to me, it's almost a given that we trade 124 at some stage. If we go to the dailies, it just shows you where the all the moving averages are quite a bit below. So I would have thought that trading around the 124 level makes perfect sense. If we have a look at 5s, 10s, you can see where that is headed back down to around the 73 to 75 area. That is more steepening. So it seems that the 10s is where the yield curve is pivoting, especially if you have a look at a chart such as this, which is the 10s 30s. Now, could the 30s come down, 10s 30s come down to 64? Absolutely they could, and they probably will. But the fact that the 10s 30s is contained tells me that the fear is not huge. The fear is one that the Fed is going to have to probably start tapering very quickly and raising rates sooner than the Fed would like. But the market is still saying the Fed will be successful in controlling this bout of inflation eventually. And otherwise the 30s would be the ones would be suffering and going down below these 80 levels. and that is nowhere near, the chart is nowhere near showing that. So maybe, yes, can we go down to 64? But that is not a big problem. The problem would arise below 80, and that really would be panic stations. What do I base my almost certainty that bond yields are going higher? Well, I base it on the 10-year break-even inflation rate that we have here. I would be very surprised if we don't trade these highs and take them out. These are highs, as you can see, from May. And also this is the one that the Fed looks at most, which is 5-year forward inflation expectations. As you can see, we are now at the levels that we were around the middle of May. I would be very surprised if we don't see these taken out. So that tells me that there is going to be continued pressure on the bonds and that there is very little likelihood of immediate relief on bond yields. Having looked at the yield curve, it now pays to look at the individual tenures. This is the 2-year note. And am I short of tens against twos? No. Because although the direction of travel is certainly for a steeper 2s-10s curve at the moment, I think the danger of having that position is too great. Look at the volatility that happened here in the 2s-10s in the period around COVID. It is enormous, and I think that the odds of doing a very sharp move back up towards 50 basis points is just too great. So 2s-10s is not my favorite way to express it. I prefer to play in the 5s and the 10s as tenures, because the danger here is, if you're long of 2s, one day you might just wake up and we're trading at 40 basis points, and what do you do then? So 2s-10s I'm leaving alone. I much prefer to play short the 5s and short the 10s. This to me is an accident waiting to happen. One day you just get a very bad accident and we're trading in the 40s and 50s. I would leave the 2-year well alone, and I would definitely play in the 5s and 10s. This is a daily chart of the 5s. We have basically broken to the upside in everything. I would have thought over the next week or two, 117 basis points is a given, but really I would not exclude a move above and going to trade roughly these levels where we were when the coronavirus struck, which is 131. So that is quite a bit of movement. I really don't like 5s and I really don't like 10s. 10s, I think 169 is all over it. But I do think that the pressure could come onto the 5s and eventually onto the 2s. That's why I'm not a great advocate of the yield curve steepening, and I'm not convinced by it, because I think the 5s and 10s really have, are giving signs that they will go quite a bit higher. To me, this becomes panic stations. If we start trading above 175 basis points in the 10s, a lot of people will start really panicking and thinking that we're going to 2 in double quick time. While we are below 169 basis points, and certainly below 179 basis points, which is 175 basis points, which are these previous highs of the coronavirus cycle. I don't think that equities are going to be hit too much, but that will be your panic trigger. That day that we break those levels, you will see some very, very bad things happening in equities, because the correlation, and this is important, the correlation between equities and bonds is very high at the moment. This is a chart of the 30s and TLT. I think it's likely that we trade this 225 level, but I think it's also unlikely that we break much below this, and I will show you this kind of 138 and a bit level in TLT. This is a weekly chart, and I think the shape of the Bollinger shows you where the real support is going to be. It's going to be around this 138 level. I think 2-3 weeks of trading around there, and we are rolling over, indicating the direction of travel is down here, but I think we will be coming back towards this 138 level all the time. 138, 139. I think there's very little juice in shorting the 30s. So what is basically my view in interest rates? Yes, the yield curve is steepening and will probably continue to steepen for a bit, but it's pivoting around the 10s. It might shift onto the 5s, and then eventually it'll shift onto the 2s when people realize that the Fed really does need to have some action to mitigate these inflationary times. Now, is the inflation supply driven? Absolutely it is. But that does not mean that the Fed is not going to panic earlier than people think. And I think that is likely to happen. But what the bonds themselves are going to say is that the monetary authorities all over the world are going to manage to control that. And I really don't see the bonds, the 30-year bonds, going much higher than these levels for a long, long time. This is a chart of Germany against US in the 10s. And yes, the pressure is upwards. 182 basis points is going to be very critical, and closes above 185, 186 will show the pressure will continue up towards the 195 to 197 level. That just shows you that the pressure is more in the US because the US is further on in the cycle. But it does not mean there is no pressure in Europe. Now, this is a chart of the bubble. Did it come back to the level that I wanted to really add? I'm short the bubble and I'll continue to be short of the bubble. But I think now we are reaching absolutely very, very critical levels. This is the level that was the highest close, and here we are at minus 50 basis points basically. If we start trading minus 47, minus whatever, this is as high as we have been. We will definitely have then, if we go back in time, we will have spikes to here, minus 33. We will probably have spikes up to here, minus 20. The bubble could really start doing a number on people. In no way should you have even the slightest desire to go against this trend, because the risk reward is just not there. Do not go against it. I don't care what the ECB thinks, does, says. There is, the risk reward in the bubble is one day you wake up and we're trading up here. So absolutely in no way should the bubble be along at any level. Now, this is a chart of the Bund. And the Bund is in a similar position. You can see where the high closes were here around minus 10. Going through minus 10 could be really quite catastrophic for the Bund. And we could go even to positive territory. The clearest chart for Europe is France. I've been saying for a long time that the French and the Italians and the Spanish will be least affected because at least they have some yield. And when you don't need the safety of negative yield, you might as well have positive yield. You can see how far away France is from the highest close, which is here around 30 basis points. I think we will go and touch it over the course of the next couple of weeks. But if France starts breaking 30, I think the next leg up will be very much in progress, and that will show you that an accident is really about to happen in all the stock markets as well. The dollar, quite rightly, is responding to the moderate increase in differential in interest rates between Europe and the US. It seems to me that all dips to around 93.14 are going to continue to get bought. I still think there is going to be a technical reaction back down around this 94.75 level, just short of 95. If we have a look at the euro itself, it got to the first level that I think is important, which is 115.52, and basically had a little bit of a technical reaction. I think that this is the real risk reward level, 114.35. Below there, and you really start having problems. If we enlarge this weekly chart, you can see how it's held this kind of level so many times, and it starts becoming a swing level below it. I don't think it's going to happen for quite a few weeks. I think this move is going to be orderly with reactions upwards. But it seems to me now that any move towards 118 is going to get well sold. Whether we are developing some kind of a head and shoulders pattern on the weeklies, we will have to see. But it just does seem to me that the path of least resistance for the time being, because of what bonds are doing, and I can't see it changing in the next 2 or 3 weeks, the path of least resistance seems to be for a higher dollar, and that seems to be the way of the world for the time being. Don't forget that in the fourth quarter, people have a need for liquidity as we go into December, and that is a natural period for the dollar to be stronger. Given that and these differentials, I think that the longer term path, the one over the next 2 or 3 months for the dollar, is actually higher and a lower euro USD with big reactions. I think this 114.35 is definitely a very good level to make 2-3% off. Given what I said about bonds and just now the US dollar, it's not going to be any surprise to you that I think that gold is more likely to trade down than trade up. What happened last week? Well, Friday was interesting. We had this break up on Friday, and I'll try and enlarge it into the what we trade 1780 and straight back down. Basically just says that these levels around 1780 to 1800 are going to get sold, and they're going to get sold hard, and at some stage we trade 1720s again. Gold is absolutely not in any kind of a trend. It's in a big consolidation. Could it be that we do a great big ABC down to the 200-day moving average? 200-week moving average? Absolutely. I mean, down here is the risk reward in gold. And that is really, and I keep on saying, if you want to hedge, you hedge for inflation, you hedge with DBC. To me, this 638 level in the ratio between DBC and gold is where it's headed longer term. That is a level that goes back all the way to 2012. as a very important level. I think that is, more or less where we should be headed. The whole of 2018, 2019, we were always coming back to it, and that's a level that makes sense to me. So if we have a look at the weekly DBC, we are overbought, but the market doesn't give a damn. Look at this area here. Basically what we're talking about is 21.55 to 22.34. And then finally we have this level 24.39, which I really would not be surprised if we saw trade sometime towards the end of the year, beginning of next. The trend is to hedge with commodities. It's not to hedge with gold. I want to start the equities review with this chart, which is the ITOT over governments, so basically stocks over bonds. If we have a look at this chart, this is basically saying, if we have a look here, this is a period basically since July, we are unchanged. Okay, but what does that mean? That means that the correlation between bonds and stocks is at the moment very high. Means that stocks cannot really fight the pull of bonds at the moment. We are not in a pure risk-on period like we were here, when even if bond yields are going up a little bit, that is more than compensated by the movement higher in equities. We are basically in a period of consolidation of this spread. Probably could even be retracement towards this 200 period moving average. Yes, absolutely. So could we be still in a range between where we were in, say, April of this year and these kind of toppish levels? Yes, absolutely. What does that portend? That means that if bonds go up in yield, equities are not going to be able to fight that move very much. They might go down a lot less than bonds, but they're not going to go up. And that is what basically the risk dial is warning about, and basically what is most likely to happen over the course of the next several weeks. And fundamentally, that is exactly what the Blue Angels are saying as well. You can see how the increase of the Blue Angels, the forward earnings, is flattening. The curve of optimism about future earnings is flattening. It's not going down, it's just flattening. But when that happens, coupled with an increase in bond yields, that tends to give us a move down to the next, Blue Angel, i.e. multiple, and the pressure is on the multiple, as it were. So instead of trading 21, 22, we will be trading 20s. So what this is basically saying is that we are not going to go down and continue going down, but that we're going to have episodes as this curve continues to flatten and flatline. We're going to have episodes of sell-offs supported by the next Blue Angel. That is all it's saying. That is all iGov is saying. To me, it makes sense that we're going to have a period of consolidation with nasty moves lower when the market panics because the bond market has done something silly that day. I think Deviations has it about right. These green levels are going to continue to be buys, but any move anywhere near this 44.30 level is going to continue to be a good sell. That is basically all that I see happening. I see the upside being very limited and some very nasty days to the downside that get bought and continue to get bought. that is what we can expect for the next few weeks, let alone 1 week, but certain several weeks. And this is a combination of everything that I've told you. You have the 5-year forward inflation expectations breaking higher. That is leading all the bond markets to higher yields. You have a very high level of correlation between bonds and equities, and therefore that is what you're going to get. You're going to get probably smaller moves down in equities than you get up in yield, but still the pressure is going to be on equities at some stage, and also the upside is going to be very limited and is going to get sold. Technical levels are going to be very important for the next few weeks, and patience is going to be very important for the next 2 weeks. You want to have the deviations in mind, and you want to have the technical levels from the weeklies, dailies, and 195 minutes especially in mind, and not trade outside of those levels. As I've just said, it's time for discipline. It's time to wait for your level and not trade unless it touches your level. Now, what are my expectations? My expectations is that these levels around 44 something, whether it's 44.26 or 44.52, who cares? Those levels are toppy for moves down into 44.40s, 44.30s, which will get bought. I think every new low will get bought. I'm not really afraid of the market collapsing. What I'm afraid of is the whipsaws up and down. So that was the weekly chart. If we look at the daily chart, and sorry, this is not at the end, here it is. You can see from the Bollinger Bands that really they have not come in at all. This is not an uptrend. This is a correction to a downtrend. Whether this is an ABC complex that, I would bet that at some stage over the course of the next 20 trading days or whatever it is, we will trade the 200-day moving average and people will panic. So to me, the path of least resistance for this market is still down for all the reasons that are enumerated. Unless the bond market turns on a dime, and I really don't see why it should, given what the fundamental inflation expectations are doing, there is absolutely no rhyme or reason for it. This market is going to be capped around these levels. And if we have a look at the 195-minute chart, we can see that we have very, very clear levels. We have 44.26, which it keeps on failing at here, and above there is 44.80, 79. So whether that is the level or this is the level, my bet is that we are going to just bounce around and come back down towards these levels and eventually move down to the 200-day moving average and panic people out of their positions. And only then, once the bond market has done everything that it needs to do to the upside in terms of higher yields, only then will we have a possibility of rallying off those lower levels. How would I justify trading, 42 and a little bit of change in SPX? Well, the help, in inverted commas, has to come from NDX. It has to come from XLK. It has to come from the tech sector, which is the most vulnerable to higher yields. So, what is the chart of NQ saying? Well, basically, it's saying that at some stage we could have a really nasty dip towards this 13,800 level without too much problem. I mean, technically, that really would be nothing to write home about. If we have a look at how it looks on the 195-minute chart, if we say that this is is going to be an ABC down, this kind of 14,000 to 13,700 area between 100% and 138% of the extension down is really nothing to write home about. We're only back to where we were at the beginning of April. We're not down on the year or anything ridiculous like that. So it's absolutely possible that we see that kind of a move. That will be the area that will be very interesting to buy call spreads. And that should be the end of the correction. I said at the beginning of the video that really we're not in true risk off, but basically what we are in, we need to readjust our sector allocation to more defensive sectors like XLF. A few weeks ago, I told you I was I was puzzled that XLF couldn't do better than it was. Well, here it is. It's done better than it was doing. You know, this kind of level again, it would not be really surprising, would it? That is another 3-4% of outperformance by XLF against everything else. In terms of periods with higher yield, steeper yield curve, that is precisely what you expect, that XLF remains favored. It's not going to go a million miles. That tells me that I'm not really worried about the ultimate performance, that the bond market is going to fall apart. You know, it's moderation and basically the pull of the bonds on something like the tech sector, which we'll look at next for the tech spreads. That is what I think is happening for the next few weeks. I think it's going to be a continuation of higher yields, people selling tech on the back of it, reallocating to different sectors. So not true risk off, but certainly some nasty days on the SPX because that's just the way the markets work. And the tech spreads definitely are changing. I think the most telling, the most interesting is this one, which is XLK over SPY. Rejection, rejection, rejection. This is going to be a very important line in a few weeks, months time when we finally break it, because tech at some stage will break it. But is it susceptible to a move back down to these levels, i.e. 33.50 from 34.70? That's a 3%, something like that, 3-4% outperformance by SPY against XLK. Yes, it absolutely is, and it marries in with with what I've just showed you, the possibility that NQ has a far more torrid time than SPY. So all that will do is allow this 200 period weekly moving average to catch up with the price action, few weeks, months in this kind of area, and then we go higher again once bond yields have stabilized. And the only way, once bond yields stabilize, the only direction for bond yields is back down or a flatter curve. That picks up XLK and boom, straight through we go on the upside. But certainly for the next few weeks, months, I think it's going to be a defensive kind of posture in XLK and techs, in the spreads and also in the absolute level as I showed you in NQ. I've been thinking a lot about volatility and what the inability of volatility to go higher means. And there's nothing to concentrate your mind than when a position that you have is not performing and you're losing money. And I'm coming up with the following. Basically, what volatility is telling you is that net, we're not going to travel too far. And that actually has been the basis of what I've been talking about and what I've been arguing about in terms of price for the indices. Net, we're not going to have huge moves. Could we be going into a period of sideways to risk off? Yes, as I've argued. I've argued the reasons. But what volatility is saying is that the net move is really not going to be much more than a few percentage points. it's not going to be a bear market in equities. It's going to be a period where higher bond yields, as I've said, move the tech sector probably more than any other. Some of that is taken up by XLF, probably not XLI, energy, XLE. So energy and basically value stocks do better. Something like the Russell is quite stable. There are nasty days on the downside, allowing volatility to move up in the 22s, 23s, but it gets sold back down because net 2 or 3 days later we have rallied, and net we've gone nowhere. We've gone 1%, 0.5%, something like that. That seems to me what volatility is saying is going to happen for the foreseeable future, that the upside is quite capped and the downside will be capped, however much people panic on a day-to-day basis, which really ties in with everything I've said. It ties in with the Blue Angels flatlining. It ties in with the support around the times 20 Blue Angel. It ties in with the supports that I showed you in XLK, in SPX at the lower weekly levels. It showed you with the supports I showed you in NQ. But it all says the same thing. There will be nasty days, but they'll get bought, and the rally will happen, and net we will not go very far. Onto the biases, and as you probably can imagine, my stronger biases are here, i.e. short of bonds. I've updated all the other levels in everything else. I think gold is abandon all hope. Basically, every rally is going to get sold because this is happening. So that is it. I'll upload the sheet as usual. I think it's going to be a couple of weeks or even longer than that where trading at levels is going to be very important. Do not be tempted to trade a million miles away from levels. If you do, you could have some nasty losses. You really want to wait for levels and only trade there. Thank you very much indeed, and tweet you on Monday.